each other. So appreciate everybody's interest and joining us today. I've got Tom Wheelwright here with us. He is a recent client of the Traction Hub. I guess we've been working together now for about 2.5 months with his team from WeathAbility. I've already given everybody kind of an overview and background, and for the sake of time, I'd like to kind of dive right in with this. So Tom, if you would maybe just kind of open it up with a quick overview of, just so we're all on the same page, starting from the same place, what the key provisions are, the 4 opportunities, I guess, inside of the CARES Act, with just a little summary on each, kind of how to apply and what can be combined within those.
Yeah, absolutely. So thanks, Michael. Thanks, everyone, for spending some time with us today on the CARES Act. This is the largest stimulus package in history by any government ever in the history, to our knowledge, in the history of the world. It also happens to be the largest tax law change we've had. So not just all of the loans and everything, but the biggest tax law change we've had since 2017. And quite a bit bigger than most of what we had in the prior 20 years to that. So this is a big bill. It's 854 pages. If you want to read it, if you need to get insomnia, I highly recommend it. Just two seconds about me, just so you know. Yes, I'm a CPA, and I am a client. We are a client of Michael, and I've spent 40 years studying the tax law. And I do a lot of, I travel around the world speaking to help people understand what the potential is, and to look at taxes not as something to be afraid of, but rather as something to embrace as a way to reduce your taxes and build your wealth. So that's pretty much me. So let's talk about the CARES Act. So really Michael mentioned, there are 4, understand first of all, we need to look at what this is and what it isn't, okay? This is primarily a stimulus package for 2 groups. Employers and employees, okay? It's not a stimulus package for real estate. It's not a stimulus package for banks. Okay, in fact, the banks hate this package, which is really clear. You've seen in the news, they hate this package. So that's who it's for. So you can break it down into 4 categories of stimulus provisions, okay? And I'll go through them quickly so that we can take questions, but I do want to give you a context for what we're talking about. So first of all, we have loans, and there are 4 loans that are mentioned, although 3 of them are not new, okay? So 4 are mentioned, 3 are not new. There's 1 new loan. There are grants. So there's loans, there's grants, and the third thing we have which for some of you will be the biggest of these 3, are the tax breaks, because there are some huge tax items in this package, some of which have something to do with the virus and the pandemic, and some of which have absolutely nothing to do with it, kind of like the $17 billion going to Boeing. Not really related to the pandemic, but it's something that they put in there. So I'm not here to comment on the political side of this. I don't care. I'm here to analyze what's going on. So let's start with the loans. The big loan, of course, that everybody's been talking about, and hopefully every one of you has applied for already because they're already running out of money, is the Paycheck Protection Program. And fundamentally, it's actually fairly simple, but there are a couple of small things that if you have not applied, or if you've applied and you can amend your application, you're going to want to consider. first of all, the amount is 2.5 times average monthly payroll. But average monthly payroll includes something that, frankly, I missed the first time through the bill, and I know a lot of other people missed, and that is that it includes commissions to independent contractors. Okay, payroll includes commissions to independent contractors. I did check with my resident expert on this, on SBA loans, and he said absolutely this was a negotiated provision. It looks like a loophole. It's not on the Treasury site. However, it is clearly in the bill. So it includes commissions to independent contractors. Here's the loophole. The loophole is that independent contractors can also apply for this. So technically, you can, independent contractors who get commissions there could be a double dip here, okay? So you pay them and you get the PPP loan, they also get to apply for the PPP loan. Now they don't get to apply until this Friday, right? Which, and you can apply now. So this has started for business owners as of the 3rd, right? And by the way, I just saw something this morning where Treasury is already asking for another $200 billion. Okay, and the reason is because this package does not just apply to small businesses. It applies to McDonald's and Taco Bell and Wendy's and all the other franchises and all the other food services that have thousands and thousands of employees. It applies to them. Okay, so they've already applied. I suspect that some of them already have their money. But this is very important. Now, here's what really makes this important is that most of this becomes a grant. And I'll talk about the grant piece as we go down the road. There are 3 other loans that if you are seriously damaged, you ought to consider these 3 other loans, okay? The first loan that I want to talk about, let's make sure, yep. The first one is just the regular 7A loan. Okay, so this is the SBA 7A loan. This is 7A loan. This is a, 7A loan. This is basically up to $5 million. Now you've heard SBA 7A loans can go up to 10 million, but the 10 million applies to the Paycheck Protection Program. Okay, really clearly does not apply to the regular 7A loans. Okay, that's a regular SBA loan. Okay, number 2. So that's 1, 2. We have the what we call the SBA Express loan. And that one did increase. That is now $1 million. Okay. The big difference here is this one, you have to personally guarantee and you have to collateralize everything. Okay, including your firstborn. This one, the collateral is way down. You don't have to collateralize your house, for example, and there's no personal guarantee. Both of these, clearly, you're going to have an existing relationship with a bank because they're busy handling the Paycheck Protection Program. Who, by the way, Paycheck Protection Program, the banks have said they will only deal with customers. Most of them will only deal with customers who are both borrowing customers and deposit customers. So if you've had challenges with your bank, get in line. Everybody has. All right. So we've actually suggested clients use a consultant who's, consultants who are experts with SBA lending, because I personally couldn't, none of my banks would talk to me. My clients, the same thing. So this is a major issue because clearly the banks don't want this to happen. All right. They just do not, they don't like this thing at all. Okay. Third, is the emergency injury disaster loan. Okay. And this is for people, these 2, anybody can get. This one, you have to have been seriously injured. So your restaurant that got shut down, a doctor's office that got shut down, you've lost more than 50% of your revenues. Okay, that's what this is. This is up to $2 million. Okay, now in the CARES Act, they talk about this $200,000 loan. So if you've heard about the $200,000, that's part of the EIDL, but the SBA says they'll lend up to $2 million. That's the most recent information. Check the information because it seems to change every day. $200,000 though is a fairly easy loan to get if you just need a loan because you can't qualify or you don't get enough of a loan under the Paycheck Protection Program. Okay, Paycheck Protection Program, anybody under 500 employees, or if you're a franchise, it's 500. If you're a franchise, or if you're in food service and you have less than 500 employees per location. Okay, so that's basically who qualifies for that. So next, and I'm moving quickly, Michael, because I know you want to get to questions. Those are the loans. Let's look at the grants. The grant, the very first grant we're going to talk about, there's actually 2 grants for employers and 2 grants for employees. Number 1 is the Paycheck Protection Program, okay? And this is basically equal to 8 weeks of payroll, utilities, rent, or interest, okay? And in this case, it's mortgage interest, okay? The forgiveness is mortgage interest. The use, you can use it for any interest, but the forgiveness is mortgage interest, okay? That's the PPP grant. So if you think about it, 2.5 times a month, you may end up with more loan than you actually get forgiven. All right, it's okay because it's a loan over 2 years at 0.5% interest. Okay, so don't worry about that. And it's deferred and all sorts of good things. I think a lot of people will use it all up. A lot of people use it all up. Obviously, there are restrictions on this. There's restrictions on the loan. There's restrictions on the grant. On the grant, you can't lay off people. Basically, you lay off people, you reduce the amount of the grant. If you reduce their pay by more than 25%, you also reduce your grant. Okay, so keep that in mind. This is Paycheck Protection Program. The idea is we want to keep people employed, okay, so that they don't take advantage of the other side of the grants, which is unemployment. All right, next. The second one for employers is the EIDL grant. And again, you should all have applied for this already. You can apply for it online. It's $10,000 per business. If you have more than one business, you can apply for more than one grant. And you're basically applying for the EIDL loan, not expecting to get it. They're going to turn you down. You're going to get the $10,000 grant. You don't get both the EIDL loan and the PPP. So you can, however, get the EIDL grant and the PPP. Okay, I take that back. I don't know about if you can get the EIDL loan, but I do know you can get the grant and the PPP. But this $10,000 reduces this amount, the amount of the grant. Okay, this $10,000 reduces the amount of the grant, not the amount of the loan. Reduces the grant, not the loan. So if your total loan was $200,000 and the grant piece was $150,000, okay, you got the EIDL, the grant would be $140,000 here and $10,000 here. All right. Next, that's grants. That's the employer grants. What about the employee grants? There are 2 employee grants, and there's some opportunities here that you may not, that most people may not have considered. The first one is, let's call it the $1,200 rebate. Okay, this is a really interesting one because this is technically a credit on your 2020 tax return that you're getting early. And it's if you get the credit because your 2019 tax return showed a lower tax, and in 2020 you have a higher tax, you still get to keep it. So there's no payback of this credit. Okay, so if you get the rebate, it's yours. If you don't get the rebate now, you might qualify for it on your 2020 tax return. Just keep that in mind, okay, when you look at the requirements. So a single taxpayer, the requirement is that their AGI, this is AGI, adjusted gross income, all right, that is less than or equal to $75,000. For a head of household, that's a single person with a dependent child. That's less than or equal to $112,500. Again, AGI. And then married filing joint, that's less than or equal to $150,000. Now that just phases out after that, okay? And again, AGI. Here's the thing. This is based on, the rebate is based on 2019 tax return, unless you haven't filed 2019, and then it's based on 2018 tax return, unless you don't meet the income requirements in 2018 or 19, but you do in 2020, and then it's based on your 2020 return. Okay, so if that's not complex enough, then let me make it a little bit more complex. There's also a $500 rebate per child under the age of 17. So then the question is, what happens to children over 17 or older? And the answer is, we don't really know, because what the law says is that if the way it's written is, it says if somebody else took a deduction for you as a dependent, then you don't get the $1,200, and obviously your parents wouldn't get the $500. However, nobody gets a deduction for children anymore. There's a credit, but there's no deduction. So this is something we're going to wait on regulations. We're going to see what Treasury says. In the meantime, I would encourage anybody that has a child, certainly 18 or over, okay, but probably 17 or over. If they haven't filed a tax return for 2019, they should file a tax return for 2019. They may or may not get the rebate. I don't know. But all you have to lose is 15 minutes sending in a tax return for your college student. Okay, it's not that difficult. Now, what does that mean for 2020? There's actually a huge planning opportunity for 2020, because all you have to do is, if you include them, not sure what happened here. Sorry.
Everything seems good on this end.
Is that okay there? All right, yep. I'm good then. I don't know what's going on. Sorry, my computer. If you, let's say 2020, you go, okay, what I'm going to do, let's say they come out and they say, you know what, if you could have been claimed as a dependent, then therefore you don't get this, okay, the $1,200, right? You still get the $500, the regular credit, not this credit, the regular tax credit, okay? But you don't get this extra $500, you don't get the extra $1,200. So here's what you do. You hire your child in your business. You actually have them work for you. You let them pay for their own expenses. Now this has to be somebody 18 or older, because if they're under 18, you're required by law to pay for them. But 18 or older, they're not a minor anymore. They pay their own expenses. Therefore, they would get the $1,200 credit on their 2020 tax return. So there are some planning opportunities here. That would be one of them. Another one relates to one of the tax opportunities that I'm going to talk about in just a minute, which if you can create a net operating loss because of whatever reason, then by the way, this is adjusted gross income. So remember, you could have had a loss in your business. You could have had a loss from your real estate. You you could have a whole lot of reasons that your income is under here, even if your cash flow was $4 million a year. You still get the credit. Okay, so that's just the way it works. They have to apply it. They do a bright line test. That's the way it's going to work. So that's this rebate. There's one more rebate. Well, one more grant, and that's the unemployment insurance. Okay, number 2 here is unemployment. And this is where, you know, everybody I presume on this call is an employer. So you have to make a decision with your employees. You can keep them on payroll and get a rebate for 8 weeks, assuming you get the payroll paycheck protection plan program loan, right? Or you can lay them off and they get regular unemployment plus $600 per week. And this goes through July 31st, 2020. So this is a legitimate choice you have to make, because like California, that's like $4,500 a month. And that's some serious money. And for some of your employees, that's probably more money than they would make if they were working for you, except that you're covering their insurance. This isn't, okay? By the way, insurance is included in the Paycheck Protection Program loan and rebate. All right, those are the grants. Let me quickly, because I want to leave plenty of time for questions, let me talk about some of the tax benefits. And I talked about one because the rebate, the $1,200 rebate is really a tax credit for 2020 that you're getting ahead of time. That's what that is. Let's talk about some of the others. One, we have the qualified plan. Now, a qualified plan, better known as IRA, 401k, SEP, okay, any qualified plan, pension plan, private sharing plan, this applies to all of them. If you can take a distribution of less than or equal to $100,000, and you have 3 years to either pay it back or the tax is spread over 3 years. So you can just treat it as a loan for 3 years. It's treated as a rollover if you pay it back within 3 years, or you can actually keep the money, never pay it back, and then it's taxed a third in 2020, a third in 2021, and a third in 2022. If it's just a 401k loan, if you're just borrowing from your 401k, it's still $100,000, but that's clearly a loan. Okay, you don't have to shut down your 401k plans to do that. You do have to get your administrator to make a plan amendment to allow for this. Number 2, I think the next biggest one is really the net operating loss. And this is a 5-year carryback. Okay, meaning that if you had a net operating loss in 2019 or 2018, of course, it also applies to 2020, but let's think about first 2018, 2019. You can now, before you couldn't carry that back since 2017. Now you can carry it back 5 years. So that's big cash flow. But think about this. Let's say that you go to the next tax break, which is qualified improvement property, also known as leasehold improvements. Let's say that you rented a building in the last 3 years, since the beginning of 2018. You might have had to pay for some of those leasehold improvements out of your pocket. It wasn't just the landlord who paid for them. If you did, those leasehold improvements probably were capitalized and they're being depreciated over 39 years, 2.5% a year. Under this new law, you can take bonus depreciation, meaning you can write the whole thing off in 1 year. So what's likely to happen, we don't have it in law yet because it'd be a regulation. What's likely to happen is they're going to allow you to go back to 2018, claim this as, because this goes back to 2018 as if it were in the 2017 tax law, claim this as bonus depreciation, which might cause you to get an NOL, which would allow you, if you claim this and then it put your income under 150,000, married filing joint, you get the $2,400, $1,200 twice tax credit, plus the $500 per child under 17, plus you'd be able to file an NOL carryback and get the refund back 5 years. So this is an actual opportunity. There might be an opportunity to triple dip. Okay, and I'm just throwing out what the laws are. I'm not commenting on, is it okay to triple dip? The law says it is. Okay, I just want to give you the options. Okay, the fourth one in here, that if it affected you, then this would be a big one. But this is, the fourth one here is really the qualified business interest. Qualified business interest. It was 30% of your taxable income, and it's increased to 50%. So if you had a restriction on how much interest you got to deduct, you get to go back and claim that. Now, the one other thing that's actually not in this bill, but it's a very important tax law change, is that your April 15th estimated tax payment plus any payment that would have been due for 2019 on April 15th is now due July 15th. This is federal, okay? Every state made a different decision on this. Okay, so some states, for example, Hawaii, their original due date for their return was April 20th. Now it's May 20th. They didn't go to July. They just went 1 month. Other states have done different things. So make sure you talk to your CPA about, you know, when do I have to pay my state tax? Do I have to file an extension for my state tax return? Because you may, even though you don't have to file an extension for your federal tax return. So because the way our country is set up with states, it's actually made that a little complicated, but that's an opportunity. Frankly, it was great for the CPAs because we've been spending, everybody I know who's a CPA, which includes all the members of our WeathAbility network across the country, everybody that I know spent the whole week last week just talking about loans, you know, calculating loan amounts for the PPP. None of us did any tax return work last week. We all spent like, you know, 80 hours helping clients with their loans. So that postponement to July 15th is actually good for your CPA, but it's also very good for you because now your June 15th estimated payment still due on June 15th. Your September 15th estimated payment still due on September 15th. One of the things we're doing as a firm for our clients is we're actually filing extensions for everybody anyway. That way we're not so worried about missing the extension on July 15th and they're due October 15th anyway. So you might talk to your CPA about, okay, when am I going to be able to get my tax return done? Because I know a lot of you get K-1s from other places. You may not be able to file by July 15th. And if you can't, okay, make sure you get an extension to file by October 15th. All right, Michael, there you go. That is as fast as I can do it.
All right, I appreciate it. So appreciate that. Lots of great insight. What I'm going to ask everybody to do, use this time. We got about half an hour left. Any questions with regards to the CARES Act, any loopholes, tax implications, anything that you heard in Tom's presentation? If you just type your name in the chat as you have questions, we'll just kind of take them in order. And as it's your turn, you're ready to go, just please remember to unmute yourself. If you got your video off, we'd appreciate it if you turn that on as well. So Chris Prenovo, go ahead, you're up.
All right, thank you guys for taking this time here. So my question has to do with the strategy surrounding bringing people back. So we've already furloughed some people. To my understanding, we need to bring back everybody that we had previous by the calculation of like January 1st to February 15th. So I need to bring those people back, but I don't really need them. So like strategy wise, I'm thinking, okay, what can we do in the next 8 weeks because I'm going to have a bunch of labor I don't need. I want to minimize the labor costs so I can maximize the 25% to use towards like rent and other things like that. Is that a good strategy to use? What are your thoughts on that?
You know, that's a really interesting one. I would run numbers because, you know, it also affects them because they're giving up their unemployment for this.
Right.
Okay. So the question is, do they want to give up their unemployment as well? Right. And remember, it's only 8 weeks. So after that 8 weeks, then what? I don't see the next, there will be another stimulus bill. It will not be an employee-employer stimulus bill, I don't think. I think it will more likely be a real estate stimulus bill because of all the people who aren't paying rent. Who knows? Some of this could be added in there, but it may not be extended. So I would run the calculation I would just compare the two. 8 weeks of pay, you know, what happens after that 8 weeks, okay? And here's one thing I don't know the answer to, and maybe you do, is let's say you rehire them and then you let them go again.
Right.
Do they go back and get their unemployment again? I don't know the answer to that. I don't know if anybody knows the answer to that. Somebody may, but I certainly don't know the answer to that. So I think that's the question. I think there's as much a question for the employee as there is for you as to which is better for them. Now, frankly, I can think of all sorts of things to get employees to do. So, you know, I think that there's always things you can have employees do, but you are taking a risk there that, first of all, I would make sure that you actually have the loan in pocket before bringing them back.
Right.
I mean, I really would, because they're already talking about running out of money. The Treasury's, they're already asking Treasury for another $200 billion on this. And nobody that I know, none of the small businesses have actually gotten this. Some of the banks, the banks are just having to fit over this Paycheck Protection Program. So I would make sure you have the money in hand before you make that decision.
Sure.
Okay, Chris, you're solved?
Solved.
Okay, great. So Graham Johnson, got you up next, and then Ann Marsden, if you'll be kind of getting ready for yours.
So I just wanted to follow up a little more with the payment protection program there. You mentioned that contractors, independent contractors that we are paying, we can go ahead and include those in the loan amount.
That is correct.
I've got a Q&A from my bank that tells me I need to exclude it. Any recommendations, one, of kind of how to deal with that? And two, I just wanted to confirm that employer taxes are excluded from the amount that you can include as well.
Yes. Employer taxes, my understanding is they are excluded. Okay. But this is the problem. It's basically, if the bank is relying on Treasury Department is saying this is not included. The commissions, but I'm telling you that the law, it's really clear that it is included. Well, banks are pretty much doing whatever they want. I mean, for example, I had a client tell me that their bank told them yesterday that they were only handling single member LLCs. If you had 2 owners, they weren't handling them. Well, that's actually backwards, because the single member LLC would be a sole proprietor, and that would be this Friday. But they're saying we're not going to handle them. I see other other banks that are have all these different requirements. We saw Wells Fargo this morning said they're not taking anybody with more than 50 employees. Okay. And then we have other banks that are only talking to the big customers. So, you know, you have 2 different issues here. One is what's the law, and the other is what will your bank do? Because the bank does have to decide they'll do it. Now, that's where you might be talking to a consultant about, can I get a better deal if I go through another bank that's not my bank, but it's an SBA lender, but you have to have somebody who has an inside track there. This is one of these things, I've mentioned it, I was on the Neil Cavuto show yesterday, that this is one of those things that is more who you know than what you know in order to get this loan. So you do need to, most people are going to need help with this because their banks are clueless when it comes to this stuff.
Thank you.
Okay, Graham, you're solved? Great. Okay,
I'm good,
Ann,
yes.
great, thank you. Ann Marsden.
Hi there.
Ann.
Sounds like we're working in the Wild West out here. So it could be that my question is moot because you used a really specific term. When you said independent contractors, you mentioned commissions. I have a number of independent contractors who I pay to deliver services as a part of what we do and to help us with our key operations. But it's not like sales commissions. To me, when you say commissions, that sounds like sales commissions. So I wondered if you had some clarity on that.
Unfortunately, I have no clarity. I've asked myself that question. I've asked people that question, and I don't think there's a clear answer on that. It specifically says commissions, and then it says independent contractor. So A includes commissions. B includes independent contractors. So the question is it only those things that are in A that are included in B, or does that mean any payment to an independent contractor? If it meant any payment, then it would literally be all of your expenses. Because every single company you pay that's not an employee is an independent contractor by definition, okay? So if you buy stuff at Costco, they are an independent contractor to you. So, you know, the question, we don't know the answer. We know what Treasury thinks. Treasury doesn't even understand the law enough to know that commissions are included. So we know for sure that commissions are included under the law. The rest of that question that you have, honestly, I don't know that anybody knows that answer. So I would be talking to your bank, and because first of all, they have to approve it anyway. And second of all, if not your bank, I would be talking to an SBA loan consultant.
Thanks.
Okay, good. All right, Christopher Roth, you're up next.
First, I want to thank both Michael and Tom for coming on and answering some of these questions. My question, Tom, is will this PPP be taxable? Will this be a taxable event?
Great question. No tax. It is not taxable. The forgiveness is not taxable.
Okay, thank you.
That's a very clear. I actually know that one.
Okay, great. All right, very good. Let's see. So next one here says Scott's iPhone. So who's this?
Scott Sadler for Johnstone.
Okay, Scott, how you doing?
Good, thank you. Hey, we did apply last Friday and got in with Bank of America. That seemed to flow well.
Cool.
One of the questions that was a little unclear to us is we had about $150,000 of expense on our general ledger to casual labor that we paid to employment agencies. Can that be figured into our average payroll?
I think so, but
Okay.
That's my opinion. Okay, I would talk to your banker at Bank of America. My opinion, I would say yes, that should qualify, because even though it's temporary labor, if you think about it, you can think of it like independent contractor commissions. It's very similar. It's payroll to an independent contractor. So I would say it likely is included.
Okay. If we wanted to go back and throw that in there now, any idea what the process of that now that we've already applied?
Yeah, you would talk to your banker and ask them if you can amend your loan application.
Okay. By the way, when we asked Bank of America for assistance on some of these questions, they said they were informed not to give us any opinions whatsoever or state anything.
Well,
they were told to keep quiet.
So here's how I would deal with that. Okay, because we know they're wimpy, right? Banks are all wimpy on this stuff. They're very risk averse. So what I would do is, if you can amend your loan application, I just amend it, put it in there, and don't ask for their opinion. Better to be turned down than not ask for it.
Okay. All right. And then any idea on, if I follow up question here, any idea on what process will come out to apply for the grant?
I'm sorry, say that again.
To apply for the grant, any idea when that will happen? I was kind of hoping
to apply for the forgiveness?
Yes.
Okay, that's going to be, remember, this goes, this is 8 weeks from when you get your loan, right? So after that 8 weeks, then you'll need to apply. I expect within that 8 weeks, we'll have some pretty good guidance on how to do that. Okay. Right. But again, you can't even apply for it until the 8 weeks is up anyway.
Yeah.
You wouldn't be able to show what you've done with it.
I was just hoping to kind of confirm that we're going to be able to get the vast majority, if not all of it, forgiven. As we were making that calculation about using standby or furloughing employees and having them use the other program, one of our calculations was, are we really going to be able to get the entire thing forgiven, or what portion of it? Or I'm concerned we might make something here, if we make too much money, like if we actually turn a profit, which I don't think we will in this time period anyway. It doesn't matter. Okay.
That doesn't matter. The most profit, I mean, literally McDonald's, I think, is turning profit right now, and they get this. Okay. There's no requirement to be losing money to get this. There's no requirement. The EIDL loan is the only loan where you have to be losing money or be down in order to get it. Okay. This PPP applies to every single business under 500 employees. There's no other requirement. Okay, so I will answer your other question. That is, are we going to get the forgiveness? It would be such horrible public policy to not. I would be frankly shocked. Okay, now that said, it's in the law, right? Could they change the law? Yeah, but that doesn't happen. So I personally am quite comfortable with it. Just because I've read the law and I know that the law says you can get the forgiveness, and you have to, and it says specifically what you have to show in order to prove it. And they're bright line things. They're like receipts and payments to your utility company, and your payroll processing people are going to provide you with the payroll. So all of those things. Now, if you talk about those things that are in the, I would say, not clear, like Ann was talking about, where she was talking about, okay, what if you have payments to independent contractors that aren't commissions? Okay, that's one where I wouldn't know the answer. I think you're taking some kind of a risk there, right? But if it's straight up payroll stuff and straight up utilities, rent, I got to tell you, I think you got a 99.9% chance. That's my opinion. Okay, you got a really high chance of getting that forgiven. It would be really bad public policy. It'd be like saying, well, all of a sudden we're gonna tax life insurance. I mean, it's just bad public policy.
Okay, thank you. Helpful.
All right, great, appreciate it. So next up, we've got Dr. Adri Rama. Dr. Rama, your question for Tom?
Sorry about that. My question is, we have let some of the, we've kept all our employees, but we have let maybe one or two go for a reason, not because of COVID-19. We've kept the entire staff. Do we need to hire to replace the people we have left? And if so, will that matter?
So it's not the comparison. So here's how the calculation works. And I'll try to explain it. And if I can, I'll think of an example. You're looking at your payroll for basically the same period last year. And you're comparing it to this year. So let me give you, I'll give you a personal example, if that's okay. So we had the same situation, okay? We let somebody go for performance, not for COVID-19 or anything else, okay? However, we still have more employees than we had a year ago. So we're not gonna lose anything because it's comparing what you have now compared to what you had a year ago. So they're just looking at, did you let people, are you more or less in employment from a year ago? That's basically what they're looking at. Now, I would suggest you ask your CPA to do the actual calculation for you. All right, I can give you a general concept of it, but I really suggest this is the time. I'm suggesting that your CPA is right now the, you're basically your financial physician with respect to this crisis. And they're the ones who've read the law. They're the ones who can do the calculations. They can help you calculate your loan amount. They can help you calculate your forgiveness. And really, they really should be the front line of this from a financial standpoint for you.
Thank you. Thank you.
You bet.
Okay, great. So just a reminder, guys, we got about 15 minutes to go here. Danny, I've got you up next. Let's see, Danny, are you muted?
No? Can you hear me?
Okay.
There
Yep,
we
we got
go.
you now. Thank you.
Oh, sorry. Apologize, my camera's not working. We've been talking about retention of employees and that are currently working in our restaurants, and wanted to know if we were to provide some sort of like combat pay or incentive pay for managers, does that get rolled into the PPP, or do you have to pay them their current salaries only as of the time you get your loan?
It's a good question. I will tell you what I think the answer is, but I honestly, I'll look at that, Michael. If you'll shoot me an email on that, I'll look at that and get you a definitive answer.
Okay.
So the rule is basically you're looking at, in order to calculate the PPP, you look at your average payroll for the last 12 months. That's how you're calculating it. And then you're going to take 2.5 times that. That's calculating the loan. Calculating the forgiveness is different. So the forgiveness is 8 weeks of pay plus insurance, rent, utilities, or mortgage interest. Well, mortgage interest versus rent, okay, one or the other. So that's what's forgiven. So in your situation, if, let's say you've got somebody making $80,000 a year and you give them a $5,000 bonus during that time, I think you're probably okay with that, all right, because you're using it for payroll. Now, if it goes over 100,000, remember you do have a $100,000 cap. So both in calculating the loan amount and in calculating the forgiveness amount, you're limited to a $100,000 annual salary divided by basically 52 weeks or 12 months for that matter, depending on whether you're doing the loan or the forgiveness. But you're limited to that $100,000. That is a limit. So if you have somebody making $150,000, then you're limited both on the loan and the forgiveness based on $100,000 of pay. But Michael, so if you'll shoot me an email, I will double check, because that one I don't remember reading it. So I just know how the basics are calculated.
Got it. Thank you.
Okay. Yeah. So Danny, if you would just email that to me when we're done here, I'll connect you and Tom to get a final answer on that.
You got it. Thanks.
Okay, great. Let's see. So PJ, you're up next.
Lou, can you see me?
We can.
Okay. All right. Maybe a silly question, but I want to ask it. Can anyone not get the loan?
So the only people who can't get the loan are there's actually two. Okay, there's two primary groups. Somebody with no employees. So a good example of that would be, let's say that you have and I actually have a bunch of clients like this. Okay, they own a 200 unit apartment complex and they have a professional manager managing it. They have no employees, so they're not going to get this loan. Okay, so you have to have an employee because it is payroll. Okay, that's how it's calculated. All right. The other people who won't get it are companies over 500. So let me give you a mismatch here. So I have a client that they hire out their property management, and the property manager has over 500 employees. So they lose both sides of it. So nobody's going to get that loan. On the other hand, if you're a franchise, you can have 500,000 employees and still get it. So franchises got a special rule exception, and so did food service. So restaurants, for example, if you own 5 restaurants, even if you had 200 employees per restaurant, which I can't imagine, but okay, let's say you did, you'd still get it because it's per location for food service.
Okay, a follow-on question. My wife and I purchased the company in June last year. And so when we're calculating the payroll, we're calculating the payroll for the last 12 months for the business entity, not just since we've been on board, correct?
So you bought the entity, you didn't buy the assets?
It was an asset purchase, yeah.
So you probably would I would think you would start from June. Okay, I would double check that with your CPA, but that is a new business technically because you bought the assets, not the entity. Had you bought the entity, I would say absolutely you're right. It would be for the entire 12 months. But there are special rules in there. And again, I haven't memorized the bill. I apologize for that.
Actually, I misspoke. We did buy the entity because we bought the previous company. Everything we bought.
Oh, you did? Okay. So if you bought the entity, absolutely. You do it basically from April to March, right? Basically. Okay. If you didn't buy the entity, or if you started since then you do basically since you started is what you do, and you still take the average, right? So you could have started, actually, this applies to new businesses. So you could have started in January and you'd still be able to get this loan.
Okay, very good. Thank you.
You bet.
Okay, great. So got a follow-on question here. Chris Prenovo, you had a follow-up for another question?
Yeah, one more thing that just came to mind. So in my understanding, there's a couple different ways you can reduce your loan forgiveness amount, either by having less employees than you had for the previous comparative time period, right?
Right.
So let's say you had 90% of the employees you had a year ago. So now you're going to reduce your loan forgiveness by 10%.
Correct.
Can you then take that 10% and use that towards rent, and then you're forgiven? Or does that reduce the whole amount you can be forgiven to the 90%, and now that's all you've got to use towards rent, including that?
I don't know the answer to that. It's a good question, and if you'll shoot that question to Michael, I'll look at it. I know exactly where to look at it. I just don't have it off the top of my head.
Okay, great.
Okay, great. Thank you. Let's see. Dr. Rama, another question, and then I got Charles Goffman.
Yes, my question was the 8 weeks payroll, does that go from the date that we close the business, or is there a set amount of dates? Like
that's from the date of the loan origination. Okay, so it's basically the date that the loan originates, whatever the date is on your paperwork, it's 8 weeks from then.
Got it. So if we
Look at that, another question I need the answer to.
So if we put the papers last Friday.
It's not last Friday, it's when the loan originates, which means it means when they fund it.
Funded.
It should be when it should be the date of the loan. So it's really more the day they fund it is when it probably starts. But on your paperwork, when you get the loan documents, it will say what the date is that it was funded, that it was the loan started.
Got it. Thank you.
Okay, great. Charles Goffman.
Can see you, but not hear you, Charles.
Charles, are you muted?
Sorry. Here I am.
we go.
Sorry.
There you go.
We've kept our full staff on planning for PPP. Let's say we don't get funded until 4/25. Can we use those funds to back pay ourselves from the previous period?
Again, it's the 8 weeks from loan origination. So you'd have 8 weeks after that, but you still have 8 weeks because it goes through June. You still got the 8 weeks. So no, you wouldn't go backwards. You'd go forwards, as I understand it.
Okay, and we couldn't, and it has to go forwards. It can't go backwards.
That's my understanding. Whether they will provide relief. Here's one thing to keep in mind, everyone, is that we have no regulations on this. I mean, consider the 2017 Tax Act before we had any regulations. Okay, nobody knew anything about it. And now they're expecting banks to fund this. I'm not trying to apologize for the banks. I think I'm not a big fan of them right now. But remember that there will be regulations that come out. I mean, the Treasury will write rules on this so that we have guidance by the time that we have to do anything other than spend the money. Okay, so I am convinced that they have people in Treasury. They have they're basically two staffs who write rules in Treasury. One is called Treasury and one's called National IRS. Okay, they're actually completely separate. Even the IRS is actually a department of, it's a subgroup of the Treasury, but there's also people who work specifically for Treasury. And my suspicion is it's those people, or it could be the banking regulators. But I think it'll be Treasury because this is basically a Treasury bill. So I think the Treasury will write those regulations. I think we'll have guidance. I'm hopeful we'll have guidance pretty quickly. They did a pretty decent job on the 2017 Tax Act, and right now there's a full-time job. And in fairness to all the, there's a lot of unknowns and questions, everything. I've read this bill several times. This is not a horribly written bill. It's a horrible bill, but it's not horribly written. Okay, I don't like the bill, but I do think that it's a fairly well-written bill. They did a really decent job of it in the short time they had. So I would expect we'll get those rules.
Okay, great. And Charles, you got a follow up as well?
Yeah. Do we know of anyone being funded yet on the PPP?
I'm not aware of them, though. I would be shocked if McDonald's doesn't have their money in pocket.
Hey, Mike.
Good. Yes, sir, Ryan.
Yes, I know of people who have been funded so far.
Oh, good for you. Wow. I'm impressed.
Okay, yeah, Ryan, prior to becoming part of an organization I'm working with, was pretty high up in the ranks at Chase, so he may have some insight there.
Oh, so you have an inside track.
I do.
Only known.
I do a little bit, yeah.
Very good. Okay, so we're right up about 2:56 now. It looks like. Any other questions before we conclude? Okay, Ann Marsden, yes. One quick question here.
Hey, sorry. It's just that I went through that whole problem of being denied initially from Bank of America because I didn't have a loan facility through them. And I frantically went around finding other contacts and got an opening with a regional bank, Renaissance Bank in the Southeast. But then the next day, Bank of America said, oh, sorry, we'll let you in. Longtime customers, even if you don't have a loan facility, we will accept because you have a depository. Yeah, well, I went ahead and filed with B of A because I thought it would be more expedient processing. But as I hear the last person who just spoke, and as I hear you say, get a consultant, I wonder if that smaller regional bank who has somebody who will walk me through it, I have a higher probability of actually getting funded than being in the big mass of B of A.
I would actually throw that question back to Ryan because Ryan's been with a big, massive bank.
So what can I help you on with that?
So the question is
really about probabilities.
Yeah, what's your likely of getting funded with Bank of America versus a small regional bank?
So, you know, I think the big banks, I mean, obviously I'm familiar with Chase. So the process is very much more rigid than the small banks. Ultimately, the bank is making the decision whether or not they're going to lend because they will take the liability should it come back that they lent money on an organization that wasn't eligible for the funds. And then they would obviously have to now put a loan on their books and collect on it after the fact. So, so the big banks are going to be more rigid because they have so many more applications to take versus a small bank who will have their own requirements and then submit to the SBA. Ultimately, the SBA has to approve it. They have to get an SBA number, but it comes down to what liability is the bank willing to take after the fact if you can't show after the 8 weeks that you used the funds correctly and now the bank has a loan on their books that they really didn't want in the first place. Does that make sense?
It does. Thanks.
Okay, great. Thank you, Ryan. We've got one more quick one from Julie and then Julie Hernandez, then we'll wrap it up.
Yeah, so super quick. We were with Wells Fargo. We tried to apply and they are not accepting new applications. So as far as finding a consultant or a regional bank, we don't have any other banks. So what would you suggest to find a consultant or another bank?
What I'm going to do is there's actually a fairly big consulting group that my members have been using. And Michael, I'll just get that to you. So when you get out the link to the recording and everything, you can get that out to everybody.
Okay, great. Awesome. Well, listen, I appreciate everybody's time and the engagement. There you have it, straight from the Neil Cavuto show to the Traction Hub. I feel pretty doggone honored. But one of the things that we're going to be doing, we are setting up a YouTube channel for the Traction Hub. And within about 24 hours, my hope is to get this recording up there with a private link. So it's not going to be publicly available, but anybody who's on the call, any other leadership team members, any of our clients, or any of the prospects that are kind of in a holding pattern right now, thinking about joining us, we're going to make this available to them. I did have a quick question, Tom. Do you have a moment for one more question? I just got one that came in. Okay, so let's see. This is from CTI. Is that Reed or?
Yeah, that's for me. That's for me.
Okay, Reed.
Yeah, Tom, our payroll's been reducing
over the last number of months, just as we've been going through some different transitions as a company. Am I clear in the understanding then that we can apply for the average monthly payroll of the last 12 months? Well, you're going to have, you're going to actually have two different computations you're going to have to look at. So yes, you are going to apply for a loan equal to 2.5 times your average for the last 12 months. However, the portion that's forgiven is based, I believe, on salary from 215. Okay. So I would sit down with your CPA. Honestly, I just cannot memorize these computations. Yeah. But I would sit down with your CPA and say, okay, so how much will be forgiven? Because we know how much you will get. That's easy. But how much will be forgiven depends on from what date do they say you can't have reduced payroll, and how are they looking at that? Correct. So that's the computation I go through with your CPA. And is it you can only be forgiven for whatever you qualified for, or what you spent on payroll, or is it if you don't meet the margin, if you didn't spend enough on payroll, you're not going to be forgiven for anything? Is it a it's payroll, which includes insurance and commissions, and that's the way I read it. It also includes utilities, rent, or mortgage interest. So it includes all of those things. Got it. Not just payroll. Very good. So payroll from February 15th forward would be what could be in the calculation. Well, it's 8. My understanding it's 8 weeks from when you originate the loan. So it's 8 weeks of payroll from when you originate the loan. Very good. And then calculating what would be forgiven would be something we want to sit down with our CPA and work through the numbers. Yeah, you do. For sure. Yep. Thank you. You're welcome.
Okay, great. So Tom, really appreciate your generosity with giving us all your time. I thank everybody for the great questions, the participation. Hope this has been helpful. And just remember, as you kind of navigate this this crisis in these uncharted waters, just please stay focused on things that matter and that you can control. And just remember, everything else is pretty much just noise. So really try to stay focused. Reach out with any questions you have. If you're in the Slack channel or you're interested in getting involved in the Slack channel, love to see a little bit more engagement in there. But I've had a lot of people want that to be something we provide. So please do try to get engaged there, and wish everybody a great rest of the week. Reach out with any questions you have. Thanks again, Tom. Thanks, everybody.